welcome to Real Men of Real Estate. Just regular guys in the real estate industry sitting around talking about issues involving the real estate industry, and we're just going to have a discussion today. Today we're going to talk about a few things. One is, what's going on with this real estate market? Are we up? Are we down? Everybody's got an opinion. I want to hear the opinion of the guys that are sitting at the table. And later we're going to talk a little bit about some of the legal issues going on. But I want to introduce the real men that are sitting next to me. We have Tunde Ogunwole sitting right here in the middle. He is a commercial real estate project manager. I have Brian Fox, who's a real estate agent out of the OC, I believe. Is that correct?
Correct.
All right. And at the end of the table, we have Jeffrey Brogger. He's the founder and CEO of Steezy Digital, which provides a platform for real estate agents to do some of their marketing through social media and other avenues. So guys, the question on the table today is, what's going on with this real estate market? I talk to people and they say, hey, you know there's this downturn coming, right? Do you guys hear that stuff?
So, yeah, the thing about the real estate market, we say, is that an upturn, downturn, it's really just functioned of what's going on in the news. Anytime something happens and it's not the norm of what has happened for a while, it is suddenly newsworthy. The thing is that when the news comes in, they're actually the ones helping to feed the marketplace. And then once it dies off and something changes, it changes again. So it's not the market's going down, it's that the market is getting honest. You can't simply ask for the next best price and see the market continue to go. So what's happening is people see that houses have not sold at the price they've requested, and they assume that means that the market has flattened and stopped. What that means is those human beings are not able to do what the previous generations the last couple of years have done, where they simply keep stepping the price into a new number and get to simply acquire it because that is the momentum of the marketplace.
Because at some place it tops out, is what
yeah,
you're saying.
It tops out. Well, I mean, there's an end to the dollar. I mean, everyone
Right.
can only afford so much, and at the end of that line, the market becomes our normal price. And if it doesn't fall also in line with what people can rent for, then it becomes a different value proposition to them. At least that's what I'm seeing. What do you guys think?
You know, as I look at the market, I think you're still in a really strong place. The market's been running pretty long, so I think that's the reason why there's some questions about what's happening in the market. Commercial real estate, we still see a lot of people have jobs. They're strong, good-paying jobs. Obviously, with interest rates rising and seeing some slowdowns, things like shutdowns, it makes people ask those natural questions. But generally speaking, we're still at a pretty good place in the market. But real estate and the economy is cyclical. So we know that when you have a good run, every once in a while, you get those corrections or bumps and adjust accordingly.
Yep, great point. And what I'll say about that is that we're not sitting on $500 billion of soft money that's about to pop. 2008 is not what's about to happen again. About every 10 years, the market adjusts, and that's maybe what's happening right now. It's softening a little bit, but it's not going to be anything like what happened 10 years ago, and that's, I think, what everyone's really afraid of. So just like you said, Brian, the news loves jumping on these kinds of things, pushing it out there, and then that actually helps to affect the consumer behavior. But in reality, the real market factors that had that massive effect previously, they just aren't here.
Yeah, 100%. So when it comes to to go back to the news and stuff, we're talking about what they do in the fuel it. So the reality is those same people said the market's going down more than likely stayed out of the market because they said it's too high, and then they stayed out of the market before because they said it's got more room to go, and then they won't sell because they think it'll come back. And there's always a reason not to pay attention, not to do something. And I'm not saying people should jump in, but the reality is it is an economics-based business. It is a commodity. We trade it when we have money, and it doesn't just go on forever. There are highs and lows based upon what consumers do with supply and demand.
So the news essentially is an industry that feeds on perpetual pessimism.
Yeah.
Right? The market's too high, you can't buy. The market's too low, you'd be crazy to buy. That's what they're saying.
Well,
and if I have a few numbers here, and I want to throw these out a little bit here, Chief. Okay, I'm going to share some of these numbers as we talk, and we'll see what they really mean.
All right.
Historic interest rates: 1970, 8.86%. 1980, 12.7%. 1990, 8.12%. 2000, 6.2%. This year, quarter one, 4.9%. It's projected to go to 5% in quarter two, 5.2% in quarter three, 5.3% in quarter three. So is that high or low interest rates? Because everybody says the interest rates are high. Compared to what?
Yeah. It's really funny. Okay, so here's the thing about that. The first swings were from 8.8 to 12% to 8.
That's
and
right.
now we're talking about 4.9 to 5 to 5.1, and we're calling those correlated. That is crazy that they would go from that 1980s, and we're really get nervous about a 0.1% change in rates. Those rates, to be honest with you, the margin average will change on a daily basis more than that. They're talking about the average of that time, but on a daily basis, they're changing way more than that. And so what's happening is people look at any volatility that's not normal and going up as incredible volatility. And what they're worried about is losing potential equity. That's why.
And I see this as it's not abnormal. I see this as we're slowly getting back to normal. It's been abnormal for the last 10 years being so low. What are your thoughts?
Exactly. If you look at 2008 and 2009, where the federal funds rate were down to zero and just above zero, people have had that as a new normal. And so just climbing back to what's average is something that we're all adjusting to. But your historical perspective over the last 40, 50 years, and real estate is a long-term investment, having that long-term perspective of 8%, 7% as being the new normal, as the traditional normal, and seeing that we're below that really helps people get a real understanding of what's actually happening in the market. It's part of the reason why we're all confident in where we are, but we recognize with that volatility, there are some adjustments that could be down the road.
Okay. Great point. And we were talking a little bit earlier about if you're looking at a short-term investment, then that might be something where you're more aware of the market. But most of these consumers out here today, they're going to be putting down a 15 or 30-year loan. So in the long term, this is a trend that's very consistent. And when you're looking at it on a longer scale, you don't need to worry about 0.1% increase and have that create fear around your buying opportunity that is out here today. There's plenty of them, and the market is continuing on.
Yeah.
All right, another figure that came out is home prices should go up 4.8% year over year according to CoreLogic Home Price Index in 2019. But I keep hearing things are going to drop. Are they dropping, or are they just a lower level of appreciation than what we're used to when we call that a drop?
So, okay, to look at this stuff economically and say, okay, the appreciation is 4.8% or 4.9%. Honestly, that's irrelevant data because that is not taking that's taking a blended average of the city, the country, the township. It doesn't matter. The reality is that there is an 8% appreciation over the course of 30 years with every high and low associated with the property. We stopped analyzing homes in the factor of 30 years, which is what that was intended because of the market swings. And now we've looked at short-term money as a replacement for long-term value.
So year-over-year values are the equivalent in real estate of like day trading.
Basically.
It's important to have a perspective. A lot of folks think about location, 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 and some of that's important. And as it applies to general trends, it's really more important to look at site-specific, zone-specific properties. That's really a better way to get a better understanding of what's happening in the market instead of national averages focusing on specific
I want to finish
communities.
that thought, Tunde. We got to go to a break right now, so I hate to cut you off. We're going to come back and pick up with you. We'll be right back on Real Men of Real Estate. Don't go anywhere.
Hey guys, how are you today?
Good.
I'm here to talk about how with technology you can make amazing worlds. Come with me. My team and I bring the Halo world to life.
Is that you?
That is me. I wasn't a math genius and I knew nothing about coding. But you guys do. You guys have the power to change things.
I want your job.
I want you to have my job.
Opioid dependence can happen after just 5 days. Know the truth, spread the truth.
Welcome back to Real Men of Real Estate. Glad to have you back. We were right in the middle of Tunde sharing something with us. Tunde, I want you to finish your thought. We were talking about where the market's going, and you had something to share with us.
I was just clarifying the difference between general market data and specific market data, and especially in commercial real estate. When you talk about what's attractive when the markets move, it's those main locations. Either they're downtown areas or areas where institutional capital wants to be, and those characteristics are very different than the suburbs or exurbs as it relates to capital allocation. And so I thought that that's important for viewers and people to know that there's subcategories as it relates to the value and how they trade.
Absolutely. There's markets and there's submarkets, right?
Yeah, I think the good thing to point out with that is statistics can be used in various different ways, right? Numbers don't lie, but people can manipulate them. So if you're talking about numbers for the entire United States, that doesn't accurately represent San Diego, where the median house price is higher than a lot of places in the U.S. And so that just being aware of that, I think, is a really important thing for consumers.
And the urban high-rise market's not the suburban single-family home market.
Right.
So you may be wondering where this other person came from, suddenly popped up out of nowhere. Jonathan Preston is a business and real estate attorney. And we brought him on board because our next topic we want to discuss is some of the legal issues that have to do with real estate. So I'm going to open up to you guys, and let's just put Jonathan through his paces and make him earn his keep today.
Sounds great.
So I do have a question for you. So we're talking about economics in the marketplace, changing bank regulations, changing rates, things like that. There was a long time ago where attorneys were much more fiduciary in their responsibility to help people actually create financing. How do you see this change in the marketplace creating more opportunity to do unique financing programs that are safe for consumers, where they have been totally protected from all that stuff? They know nothing about it.
Well, seller-created financing is a mechanism to allow a buyer to acquire a property that may not appraise out with a first trust deed. So what happens is a lender believes that they'll loan on a property, let's say it's 80% loan to value, but the sale price is higher than that. And so how do we close escrow when the sale price doesn't pencil out? So what we can do is have the seller do what's commonly known as a carryback loan, or a second trust deed is the most common way of how this works. And basically it involves a second trust deed. It can be insured the same way. And then the funds to pay the second trust deed would be paid through a loan servicing company is the best way to do it. You don't want to get involved in actually collecting the funds yourself as the seller. I do not advise that. I'd rather you engage the services of a trust deed servicing company. The reason why is because the trust deed servicing company will also provide the interest statements, they'll handle the foreclosure, they'll handle any sort of services you need relating to that transaction.
So just to be clear, we don't think the market's going to go anywhere. There's not going to be anything drastic happening this year or next year. But even if there is, there's options.
Yes, correct.
Yeah, that is correct.
So a tag on that, Jonathan, the private lending idea of using a self-directed IRA, self-directed health savings account as a funding mechanism, can I use it for just investments or my house, or can I use that as that bridge because the bank loan won't cover it? What can I do with that?
Well, you have tax consequences whenever you're using a self-funded IRA or an IRA, and you need to talk to an accountant about that. There are real estate investment trusts. There are ways to basically take a self-funded IRA, put it into a mechanism that could avoid taxable consequences should you remove the funds to acquire a property. But generally, it's not what I advise, because the tax consequences usually are more severe than what it's worth.
Okay, thank you.
And just to be clear, this is not really something that I would think of if I were in this position, would be to talk to a lawyer. So this is really good insight for me to know that, if that were to be a case, not only my agent, my broker, going to them as a resource, but also a law professional could actually help with a lot of this, even in financing.
Yeah. To that point, in commercial real estate, especially in development, there's 3 B's that I tend to think of. The broker, you're looking for a broker who can bring you the deal. You're looking for a banker or some type of capital, and then the brains. Either the developer and their team have the brains, and we see the legal profession as a critical resource to have as part of your team. And regardless of markets, we always want to talk to various attorneys in their special fields, whether it's entitlements or if it's in contract negotiations. What are some of the key things that people should think about from a legal standpoint if the market were to turn, or if you're looking at downside protection?
Okay. Unfortunately, lawyers don't have much of a remedy if you happen to owe more money on your property than it's worth.
You can't negotiate that?
You cannot.
That's absurd.
It does cause defaults. There is a mechanism in Chapter 13 bankruptcy that allows you to lien strip a second trust deed, but there's also qualification issues for that. Unfortunately, if you're upside down on your house, there's not a lot of remedies apart from loan modification services if you actually default. But those services are typically ending along with products that came out in the real estate crash of 2008.
What about, so one of the things that is still around today, and I've been working on it, we were talking about this before, is lease options and structuring a good deal on lease option. Rents are going up like crazy. There's the other side of it is people want to get into these properties, but they would need to do some stuff along the way that qualifies them, that they can get the payments in, they can start putting towards the down payment now. What is the best way to structure a lease option? Can you kind of explain that a little bit?
Lease options are excellent vehicles to allow a tenant to acquire a property, and it can be directly negotiated with the landlord, who is also the seller. The common provisions that a tenant could benefit would be to use a portion of his rental money towards the down payment, He could also use a portion of his rental money to actually acquire or to perform improvements on the property. Key issues are basically the strike price. How is that calculated? You generally want to have an attorney prepare the lease option. It does need to be recorded in the county recorder's office. Usually a strike period might be, say, a year from the time that the rental period starts. Other key provisions is that the tenant has to maintain possession, cannot sublease, must be current on the lease, cannot default in any terms of the lease. Otherwise, that is considered a default on the option as well.
Yeah. Sorry, strike price. Can you just kind of explain that real quick so people know?
A strike price is basically the amount that the property is going to be sold during the option period. An option period might be a period of as low as 3 months, and it might be a year and a half or 2 years from the time that the rental period starts. All of that is negotiated. The strike price can be negotiated based on fair market value. The parties can agree in advance to use 3 different appraisals and then do an average of those. They can also decide to appoint brokers to perform what's called a BPO, broker's price opinion, to achieve a price, or they can just simply write the price in if they want to predict the future.
Which I think is what we're trying to do, predict the future.
Some of the things that really jump out to me as you talked about that, there's more of a collaborative element that happens in that lease option where the buyer and the seller, or the potential buyer and the seller, are more collaborative in the structuring of that deal.
Absolutely. A lease option is great if you have a good relationship with your tenant. If you know your tenant, you trust them, and you believe this is going to be a better investment for you, especially if you believe the market, as a landlord, if you believe the market is going to appreciate in the next 2 years, this is the way to go. If you think it's going to be flat for the next 2 years, allowing the rental period to catch up with the market might be a good option. It also is great for the tenant because the tenant can get into a property. If he really has a financial interest in the property, he can start making improvements on that property, and he can live in it at an economic price, and then in 2 years he can acquire it.
Are there any downsides of doing lease option? Like letting someone be in possession of your property while they're renting it, making payments, and then claiming ownership? Is there anything in there?
Well, if a tenant defaults on the rent, he's still subject to eviction proceedings through an unlawful detainer. That's obviously indicative of any rental property. Downside might be that if the tenant struck a bad deal or if the landlord struck a bad deal, it needs to be negotiated. If the price that's actually the strike price is going to be too high, then you probably don't want to go there.
And who's responsible for maintenance and repairs during this time?
Well, that's negotiated. Usually it's the tenant that's responsible to maintain a property.
Wow. Okay. A lot is negotiated, and these are things I wouldn't have thought of, which is another reason why a lawyer would be a huge asset in structuring this deal.
Yeah, I wouldn't do anything in real estate without a good real estate attorney and a good tax accountant or advisor so I could structure things the right way. Because you got to start with your outcomes that you're looking for and work backwards from there. Otherwise, you'll find that what you thought you were going to do ends up biting you. Even how long you keep something makes a big difference in your taxes. Less than a year, more than a year, 5 years makes a big difference. We're going to be right back after this. We have to take another short break. We come back, we're going to wrap it up. Don't leave. This is Real Men of Real Estate.
Put the keys down, Kevin.
But I'm going to drive home.
There are several warning signs present that you shouldn't be driving.
My text to emoji ratio has gotten a little out of hand.
A little?
Yep, I'm definitely going to call a ride home.
First time I tried Vicodin, and it was laying around my mom's house. I didn't know they'd be this addictive. I didn't know how far I'd go to get more. Opioid dependence can happen after just 5 days. Know the truth, spread the truth.
Welcome back to Real Men of Real Estate. Before we go, I want to get some final thoughts from everybody. And in the spirit of giving, I'm going to go first and pass it around the table. We talked today about where the market's going. I remember back in 2001, and I would talk to people about the market. Everybody said, there's a downturn coming, don't you? And there was a small downturn in the summer before 9/11 happened. And what happened after that? It came up and went gangbusters for the next few years. I also remember in 2005 sitting in an economic forecast, and I still have the slide deck that shows there is no bubble to pop and nothing's going to drop. It'll be a slight correction and we'll be back on track. We know that didn't work out. So what I do know is that trying to forecast the economy is like trying to forecast the weather for tomorrow. It's all a big guess. So educate yourself, do the best you can, and don't listen to hyperbole and don't listen to the scare tactics, and certainly don't listen to anybody that's telling you their economic system because they just want to create uncertainty. What do you got for us, Brian?
So for me, when I'm looking at the economics of everything and people talk about, when is the bubble bursting, what I try to impress upon them is that the reasons that we've had these economic drops over time have been completely unrelated to the industry itself. So for instance, in the 80s, there was the savings and loan crisis, which was a real estate drop, but had nothing to do with real estate, not specifically. And then there was the mortgage crisis. Now we have to look at what's going on around us to say, okay, what is tied into our money that has an ability to inflate us, and where are they having problems? For me right now, if I was looking at anything, I'd be watching a lot of foreign affairs to say, here's how trade works, because our money is overlapping significantly. And as long as that stays stable and jobs stay where they're at, we're not going to see people start fire selling their houses, but we should be paying attention because that will have an effect.
I think one of the most important things to realize is to have a long-term perspective. As a developer, you're thinking not in 1 year and 2 year increments. You're looking over the lifetime of your career on each and every deal and property, and looking not only at upside scenarios but downside scenarios and making them work in your pro forma. Looking at exit strategies is another element that we touched on in this episode. There's a couple things that I just think I tend to keep in mind wherever we are in the cycle. Obviously, knowledge. This show, we get to learn a lot. I think off camera, we learned a lot from each other in terms of what's happening in our market, what the specializations are, and trying to bring key members of our team. So boosting your knowledge and getting around knowledgeable people, I think, is one critical element. Obviously, a niche and good markets, people tend to put their hands in everything, and getting more clear on what your product type is, what sector you're in, what geography you're in. Those things can really help you through any type of cycle. If you're a specialist in your market, you're going to do well. And then obviously your knowledge, really trying to make sure that your knowledge base is really, really strong and finding credible resources to do that.
Yes, absolutely. Lawyers usually don't get involved in the economics of a transaction, and courts do not either. However, if there are certain things that do not pencil in, for instance, seller-assisted financing is probably the most common, you definitely need to get an attorney's opinion on how to structure the deal to make sure that the documents are completed correctly. The lender, here it's the seller, still has to comply with RESPA and with Regulation Z as if they were a regular formal lender. And so without an attorney handling that, it's very difficult.
How much money did people lose in 2008 who didn't sell? None, right? So I think what all this comes down to is asset allocation. It's an investor strategy to make sure that you're not over-leveraged and you're not making decisions that are going to force you into a sale when the market does go down, if it does go down, right? So talking to professionals like this, they're going to make sure that you're making good decisions, and that's the importance of having a consultant on your side during these times. So with that, that is the Real Men of Real Estate. I'd like to thank our guests here, Steve, Brian, Tunde, Jonathan. I'm Jeffrey. Make sure to tune in each and every week on EAN TV, the Real Men of Real Estate. We have many topics coming up in the real estate industry, and you won't want to miss any of them. Thanks.